Hey guys, we're here. Saturday morning. You guys said you like the Saturday morning format instead of Saturday morning cartoons. You get Saturday morning macro. We're here for it. So, a lot going on in the markets, a lot going on all over the world recently, and no better person to talk to than my co-host Kashop about these things. So, looking at the markets, one thing that's kind of I should have started with a different chart, Kashop. This is my bad, guys. But global yields, this is something that just keeps boggling my fucking mind. And I was thinking about this recently, and Kashop, I gotta talk to you about this one because it's something that you'll get more than other people. And looking at the market and looking at the US yield. So looking at the US, we've been stuck in that range for a long time. But if we look at Great Britain obviously made a big move, coming back a little bit, but obviously broke out of that range. Then we're looking at Canada, obviously just getting out of that range. We're looking at Japan, obviously way out of that range. We're looking at Germany, broke out of its range. So basically, across the board, we're seeing global yields moving higher, but the U.S. kind of been stuck sideways. And I was looking into it, and I was like, we aren't issuing bonds like we used to anymore in the 30 year. And so I'm wondering if that's a situation where it's like really, well, not really wondering. I kind of see that structurally, this isn't really going one direction or another, and that might be one of the catalysts for it. But really, it's like, manipulations in markets, I don't think about them much because they don't last for a long time. If you're looking at any type of market, manipulation. Look at the silver market. We've talked about that, before. I try to stay away from that thinking, not because I think it doesn't happen, and because I just think it's something that people, get too stuck on as traders. We're all sitting there going, the market's being manipulated. It's the end of the market, and so on. I can't buy silver. Why? It's being manipulated. I remember there was a couple years ago, people were like, "Oh, just trade platinum. It's not as manipulated as silver." I mean, all these ridiculous things were coming up in the markets. And really, it's like, no, things will move at some point, and usually in a very violent way. I mean, and silver has proved that to be a very good move and a very violent move very quickly. And so I'm also wondering about the yields here, is wondering like when this thing starts to move. It's moved, it's getting to the top end of that range, and it's only continued to make higher highs and higher lows ever since that bottom of last year in 2024, or sorry, 2 years ago now in 2024. And so now we're at the top end of the range. What do you think here, Kashop? Do you think we're in a situation where the yields globally will continue to trend higher, or do you think these things are going to move lower? I want your opinion on this because I know like there's a bunch of different dynamics. There's a Fed rate, there's 2 year bonds. Everybody doesn't, most people don't know a ton about bonds, but there's a lot to talk about here. So please break down what you're seeing here in the short end of the curve and the long end of the curve, and we'll try to explain these things well for people who don't really pay attention to bond yields as much as we do.
So, sure. Jason, so the short answer, I think, is bond yields are going higher, and I think we are on consensus on that. Now, as you pointed out, there are two factors at play here. One is the short term, and the other is the long term. So, the Fed, or pretty much any central bank in the world, what they control is the short term. So, the federal funds rate, which you see on the news or on Polymarket these days, which is de facto news, what you're seeing is the short rate. That is the rate that the Federal Reserve actively controls. And that is also their mandate to control. So that rate, I think we are going to keep pushing it lower and lower. We may probably even start to see zero. And I think Swiss National Bank has already taken that rate negative. So we are going to see more of that. Now, the bond market, that is the yields that you see, the charts that you have put out here. So these are on government bonds of different maturities. So you take 2 year, 5 year, 10 year, 30 years, all the way to 30 years. So in this market, which is pretty much controlled by investors, but is mostly institutions and pension funds. So in this market, and of course the banks, in this market, what you are seeing is yields are going higher, and that's a structural move. Now, why is this happening? Because, I mean, now it's ancient history, but 3 years back, Silicon Valley Bank was in crisis. Now, why were they in crisis? Because they had a lot of deposits coming in, and what did they do? they bought the bonds. And then when the Fed hiked rates, they pretty much went bankrupt. Now, almost a lot of the banks have faced the same situation. And after that, they have sort of understood that they need to start de-risking. So until that point in 2022, when the Fed raised rates, everyone thought bond was a risk-free trade. And the reason for that is if you go back the previous decade, we have seen interest rates go negative, which is absolutely crazy. So investors were at the time, say Nestle was issuing a bond, investors were saying, here's my 100 euros, you pay me back 99 in 10 years, and I'm fine with it. Which, if you think about it, is completely irrational behavior, but that's what people were doing. Now we are seeing those excesses getting corrected, and we are seeing inflation flare up so drastically that, I mean, the US had to just say we are going to stop publishing the CPI numbers because, we don't want to even lie about where inflation is. Let's just stop publishing the data. So it's gotten that bad. Now, everyone's aware of it. Gold is making everyone aware of it. And it's not just gold now, it's aluminum, it's tin, it's copper, it's pretty much everything. Commodities across the board are getting expensive. Now, earlier, sometime last year, Donald Trump put out a tweet saying egg prices are down 80%. And that was completely not true. It was all fake news. But that is what they wanted to make the market believe so that they could sell some bonds. And guess what? They failed to sell those bonds, and now yields are going higher and higher. And now this thing is gaining momentum of its own. So once a move like this starts, well, it's not going to stop. And how bad can things get? Would you try to bottom fish? Would you try to do some mean reversion trades here? I would say no, because if you go back to 1970s, this is the best example that we have. In 1970s, a lot of British bonds went to near zero. They had in 2 years they had drops of like 60 and 30% or something, which pretty much zeroed out the bond investors. Now, if bonds can have such crazy downside, why would you do a mean reversion trade? Why would you try to pick a bottom? Why would you try to do anything counter to the trend? Well, you shouldn't. You should just avoid them altogether. And that's why I think yields will keep going higher. And whatever pullbacks we get, don't buy the dip.
Yeah, I think people continue to look at bonds like it's going to be this safe trade at some point. Like the smart trade really is kind of how people are talking to me about it. Well, I mean, once again, you look at this chart, you look at TLT, it looks very different. So people keep looking at TLT and they're like, okay, well, look at how cheap this thing is. And TLT looks like in your brain, you think you're buying this type of a bottom, which is absolutely wrong and insane. I mean, this is like basically, if you think about it, we're kind of in this zone, if we're thinking about bond yields. So this goes back right before the 70s happened and the great inflation era. We're kind of in this sideways zone where we can't really break out. Globally, yields were also moving higher at this point. A lot of other countries were having massive inflation in the late 60s. And so global yields start to move higher here and are outpacing the US. And then all of a sudden, the US starts to catch up in a violent, very quick way. And I think that's probably what we're looking at here for yields. I mean, God, like I know everybody keeps being like inflation isn't there, but it's like get a fucking magnifying glasses. I don't know what to fucking think anymore. But it's like if you look at aluminum, you look at palladium, you look at lead, you look at nickel, I mean, Jesus, it's across the board. It's insane. It's absolutely fucking insane. And so if you look across the board at all of these things, you're just like, how can anybody look at this and think this isn't inflationary? Now, I understand like CPI reports are going to keep coming out and they're going to be like, wow, look at how low costs are of this and look at this. And it's like CPI reports, things like metals that are used in, let's say phones, let's say cans, let's say food, whatever it is, like to package food and so on. Not that it should be in your food. It is in some food. That's a whole other story, especially in the US. But basically looking at all these things and going, okay, these are aluminum, lead, nickel, gold, silver, palladium, platinum, and so on, all the copper, all these metals are inputs into things that are in the CPI. So these are going to take a while to show up in the system. They're not going to show up very quickly. So it's the same at the same time, like, the only real weighting in the CPI report of commodities, like a straight commodity, is gasoline now. It used to be coffee. They put that in an index now, and it's a very small range. That's why they'll say, oh, it's in there. It is in there. It's like 0.1 or something, 0.01. So you're really not going to catch that in any meaningful way in a CPI report. Same thing here with, if you're looking at gasoline, like that's the only one that you're going to catch in the CPI report. So, of course, it looks like everything's fine, but also we have to remember we're coming from these elevated levels in 2022. So we're coming from these elevated levels of inflation. Then inflation basically looks very similar to this chart. It chops around, it goes sideways, but we haven't really gotten rid of inflation. We're not going back to pre-COVID levels. We're nowhere near that. Even the rate of change is still pretty high, even though we had this massive move. So inflation is very sticky, and right under the surface, anything that happens is going to lead this right to the upside in a very massive way. Same here, like I think we're going to look more like this. Now, I don't know if we get all the way to this point. I have no idea, but I still think there's one more big wave of inflation coming at the least, and where there's a lot of money to be made. And so, looking at this as well, we're looking at gold to the S&P 500. Now, another inflationary time, especially in housing, as we all knew until it collapsed in 2008, was we saw gold massively outperforming the S&P 500. It's another thing. We talked about this earlier this year. We got that pullback here, and everybody was like, oh, yeah, gold's done. And it really looked like we were more here than anywhere else. We certainly weren't here yet. So I still think that there's still some more upside in the precious metal space. What do you think? Are you still holding some gold mining stocks? Are you still thinking we have some more upside here? Or do you think this the party's been over in gold and silver?
So I am definitely holding on. So I recently wrote a report for subscribers where I titled it "Don't Go Chasing Parabolas," meaning just don't. If you are looking at buying gold and silver, and if you understand the fundamentals and you understand why it is moving, do not buy now. That does not mean whatever you hold already you're supposed to sell. Does not mean that you have to try to anticipate the correction. And obviously, every move there will be a correction. That is just how the market works. All I'm saying is don't chase it now. Wait for it. Even if you end up buying at a higher price, that is still fine because you will be catching it at the right time in the trend rather than right now where everyone is chasing it. And the reason to also not chase it now is because it is a really kind of a bad behavior. It's the kind of behavior you would wish you hadn't learned, and it's going to take you a lot of time to unlearn. Because if you're always buying after a parabolic move happens and then you don't have a strategy for playing it, then you are going to lose money in the long run. Maybe not right now in gold and silver, which looks set to continue, but you do this over and over again, and some point you'll have a big loss. So that's why I wrote that. But for me personally, I'm absolutely holding on to gold. I'm absolutely holding on to the silver miners, pretty much everything. As for my allocation on the metal space, I hold the physical metals. I also hold Pax Gold. I don't have any GLD or SLV or any of those ETFs. I prefer the mining stocks in the trading account. That's my positioning. And I can actually see myself increasing my exposure this year, whether or not we get pullbacks. As in, by pullbacks, I don't mean whether or not we get a 5%, 10% correction. Like, who cares about that? Like,
Mhm.
even if we get a 30% dip, I'm adding. Even if we just go flat for a while, I'm adding. My bias is to keep increasing my exposure and not second guess this thing because it has started running for really, really good reasons, which means it can keep running for a good many years.
No, I agree. I think we're looking at some big moves coming up here in these markets, and I think a lot of people aren't really prepared for how wild this could actually be. And once again, it's a like don't think it's not going to be perfect, like even looking at this chart, like this isn't gold, this is gold versus the S&P, but there's a lot of periods where gold had massive pullbacks, not compared to the S&P 500 obviously, but it had some big pullbacks that were very new trends that were buyable, whether you waited for them to base out and bought a new high. whether you were just kind of sitting and waiting for dips, whatever it is. I think there will be some buy opportunities here going forward. But if you have the positions, I agree with you completely. Is just sit on your hands, let this thing run, see where it ends up. And so here, is a new area that I've been talking about this chart for a while, this divergence between crude oil and the US 30-year yield. And we were talking about earlier, there's some reasons why we haven't been able to really break out in the US yield wise. But once again, it's still like we're not seeing this show up in something that's usually heavily correlated to higher yields, which is oil. Oil hasn't really moved yet. So here is a time where I think that this is going to kind of come into play. We'll probably see this correlation come back together, and oil probably move more to the upside here. It would have to make a big move to get back to equilibrium, but I think it can. So, Kashop, you're looking at oil. Are you seeing anything in the oil and shipping markets currently that people should have on their radar, ready to buy, or any areas in those markets that you like?
So, oil personally, I have exactly one oil stock, and it is not an oil producer per se. It is an oil producer which also has exposure to the LNG space. It also has exposure to the natural gas space. And the reason for that is because right now the producers, you can own them. I'm sure you can find a lot of cheap ones, but I do not know when they're going to start moving. It's like, say you bought Newmont in 2023, great entry, and what happened for the rest of the year? Well, you did okay. You didn't lose money, but you did okay. Now, let's say you own Newmont in 2025. Well, it was the best performing stock in the entire S&P 500. Now, that's great performance. So, I do not want to own the oil producers right now. I do like to bottom fish a bit, which is why I have a stock which pays a great dividend. But apart from that, my picks in the space are, as you pointed out, it's in the tankers, it's in the oil tankers. And to give a bit of background on that, so in Q4, the rates for the very large crude carriers, the biggest kind of tankers, they just absolutely exploded. Now, the reason for that is, I mean, we are all seeing what's happening on the Venezuela front, but even before that, what happened was the U.S. Treasury started sanctioning a lot of oil tankers which were involved in the Russian shadow trade and the Iranian shadow trade. And now they have kind of added to it and they've started going after the Venezuelan oil trade as well. And the space has gotten so crazy that the US is now seizing Russian flagged vessels in international waters. Now, I think we'll have to go back to the 1980s Iran Iraq war or some other period like that to look for a president. Now, this kind of setup, this kind of behavior, it's unimaginable. So when it's happening, what happens? So, well, the people who have the ships now they're taking more risk, so they're going to need more compensation. The insurance companies are going to get involved in high premiums. It's going to be chaos all around. Now, the thing with shipping is, unlike other industries, shipping thrives on chaos. In fact, some of the billionaires in this space were made exactly during these times of chaos, like the Iran Iraq war. So, in a setup like this, you want to be long the tankers, and we can already kind of start to see the moves happen in some of the big tanker stocks. But I think that's just getting started, and we have a room to run. But the caveat here is that these ships, there is a limit to how much they can earn. And the reason for that is if you take a very large crude carrier and you take two of the so there are three sizes which are mainly into, not to go too deep into it, VLCC, Suezmax, and Aframax. So you can kind of substitute between the three. So when rates go too high on one, then people just go on to the smaller vessels. So when that happens, well, there's a natural limit to how high the rates can go. So you kind of have to be on the watch for that and not buy something that is already hitting its full valuation because, well, you buy at too high a price, then you're not going to get the upside. But I think if you buy in now, you should be fine.
Yeah, I think there's some interesting setups here, and I'm like you, where it's like I'm nibbling right now. Like there's a couple things that we can pick up here that look okay, but I don't think it's a good idea to just go heavy into energy just yet. I think it's something to be patient about. you know, it looks like it's starting to move up. It looks like it's, you know, if we look at energy stocks, ExxonMobil's breaking out. That's a good bellwether to look at. So we're starting to see some of these big movers starting to come into play. But once again, be careful here. We've seen this thing kind of, it starts and stops. Just take the trades as they come. You know, don't think about it like, you know, it was frustrating last year when I traded this thing. Think about it this year. Hey, these things are setting up. This is a good setup here. I could buy. Take it trade by trade. Buy the strongest names. A lot of people keep asking me about front running some of these very small cap names, these very speculative names, and it's like you could be holding those for years if that's the case till they move. Doesn't mean I think that I don't think they'll move. It's just you're also betting on everything else to move. If you buy, start with for me, I'm starting with the largest names. You buy the large cap names, those start to move. Take this next signals as they come through, and so on. And we'll see where we end up. Speaking about energy, something that you know a lot of that I want to pass to you as well, the uranium space. You know, we're starting to see a lot of hype about uranium, a lot of stuff going on with the uranium stocks, seeing if they're going to move higher. And they've been really performing well to start this year. So what are you seeing in the uranium space? Is there anywhere that people should be positioned? You know, you don't have to give the individual stocks, but do you think the juniors are now where you want to be? Do you think it's still the large cap names? What do you think about the uranium space?
So I think if you go back to, I think, 2014, 15, the uranium guys, they were a niche. I mean, so gold was a niche back then, and that was because commodities as such were kind of a niche. Like the big banks had even shut down their commodity trading desks. So if you go back to that period, gold was kind of the big daddy of them all, and then silver had a few followers, and uranium, they were like the lone guy at the party. Almost no one cared about uranium. But if you go look at the pitch decks for uranium from that era, what it shows is that demand will continue to grow, and that's just math because once utilities turn a reactor online, they're not going to shut it off for lack of fuel. So the demand is pretty much baked in. The supply side, mines were shutting down. So the supply was going down, demand was going up, and at some point, whatever excess stockpiles were being sent into the market to meet the shortfall, they would get exhausted, and at that point, the price would explode. Now we have come to that point where those excess stockpiles have been exhausted, and the price is exploding. So it's just what was predicted to happen based on the math has actually happened, and uranium is going to go higher. Now, what that means for the uranium stocks? Well, the uranium stocks, it's kind of become like GameStop or any of those meme stocks right now because everyone wants to buy URA and URNM, and I think there's a URNJ, so the juniors. So everyone's buying these things. There's no real concern for the valuation, concern for what these companies actually represent. So in this scenario, it's like when the wind blows hard enough, the pigs will fly. So you want to be really selective. I mean, you can definitely play that game. You can just say, I think this deposit in this part of, just to pick an example, Niger is a great one to pick, and has a great shiny promoter. Let's go for it, and maybe you make money that way. And it's a bull market, right? So the pigs will fly. But if you want to be a little more conservative, and I'm getting a little gray hair, so I want to start being conservative. So the thing to do is to just buy the metal. Now, that doesn't mean you get drums of uranium delivered to your home and you store it. You just buy stocks of companies that do that. So there are two which are very attractive. One is the Sprott Uranium Trust, and the other is Yellow Cake in London. Now, of these two, I think Yellow Cake is the better opportunity because the Sprott Trust has some governance issues around how they are structured. So you want to just go for that. So I think that's a pure play. And for me, in the portfolio, I do have a company, Energy Fuels, which I'll be talking about more over the course of this year. It's a way to play both rare earths and uranium. So I already have a six bagger on it, full disclosure, but I'm very, very bullish on this stock. And that's the way I see myself playing this trend.
Nice. No, I think it's for me, I'm still looking at the uranium space. I saw, what was it, sector wise, the uranium, I think, was leading to start the year. I don't know if it's still there. Somebody sent me a what was it, a 2x leveraged silver ETF, and was like, see, uranium isn't leading. I'm like, that's a 2x ETF. That doesn't mean anything. So once again, it's like looking at it, I think uranium's still kind of leading the year. For me, I kind of always think about the beginnings of new years a certain way, which is I think it's a good tell of where money is rotating to start the year. A lot of new allocations, a lot of new capital, people closing out trades from last year, waiting to start new allocations this year. Trading in a as a professional trader for, like, let's say, a big bank is very different than being a trader that trades a small fund or something. You've got to, you have allocations, you get new money at the beginning of the year. You might not be able to even open or close trades at certain points. They might say, hey, we're having a freeze right now. There's a bunch of things that happen, but it really leads to a lot of money on the sidelines to start each new year. And they want to, put that capital to work, put it in different areas. And so usually why I look at year-to-date returns so much is I can see where money's flowing all year long. And to start the year usually is something that I've noticed continues throughout the entire next year. And so if we're looking at, something like uranium leading the way, I don't doubt that's going to be a theme for this year. Same with energy has made a nice move. I think it's number 2 out of the spider sectors besides materials. Materials, I think, is number 1 this year still. I'd have to check on that because I haven't checked in a couple days, but recently I looked at that and materials were leading the way. So, a lot of these companies that really haven't, like, materials were doing well. Like, obviously, we know that. Metals and mining, some of the gold miners are in there, industrials, but the chemical stocks are the biggest names inside of the XLB ETF, and those haven't gone anywhere for a long time. Those are finally starting to move. So it looks like just a more broad rotation moving into these different areas. And also, if we look at the Mag 7s, those have massively underperformed to start the year. So are we starting to see this rotation into the things you and I have been talking about for a while, where the Mag 7, even though I felt like the Mag 7 weren't a place to invest the last year, basically, I noticed a lot of people are still very into that, still hyping it up, or they'll be like, Jason, the XLK was the best performing spider sector. And I'm like, yeah, did you look at gold miners? They're up, 170% this year or something crazy. That was in 2025. And now they're leading the way still this year, above XLK, obviously, and so on, are gold miners. But uranium's above that. Energy's doing well. Some of these international areas are also doing great. Latin America mainly. So, what do you think here about, any other areas inside the commodities markets that you're really looking at? Whether it's nickel miners, like something. I feel like we're getting into that very speculative time where it's like I'm talking about nickel miners. I never talk about nickel miners. Uranium stocks, great, but nickel miners, those don't come to the list very much. I have a bunch of aluminum stocks in the portfolio. I have steel stocks in the portfolio. I'm long nickel, I'm long lead and futures. Like, it's getting to that real speculative time in this market. So do you think there's any other areas people should be looking at if we're looking at these metals we're listing? Are you looking at any of these nickel miners? Because I know you actually understand about these things a lot more than I do.
So nickel specifically, no. And the reason for that is, I mean, you know what happened with the LME futures, and that market is completely manipulated. So
Yeah.
I would just stay away from nickel. And the second reason is it's a black box. It's Russia, it's Indonesia. No one knows what's going to happen. Now, the way to play it, the way to bet on nickel here is to look at, okay, so nickel's controlled by countries which are not exactly friendly to the US. So is there any nickel deposit in a country that is friendly to the US that could potentially become a mine if there are issues with Russian production or Indonesian production or something like that? Now, if you look at this, then of course you're going into the junior space and you're looking at the companies which have these assets, and they are mostly the good ones are mostly in Canada. So then you're buying these stocks, you're allocating maybe 0.25 or 0.5% of your portfolio to them because essentially, they are call options. If there is a flare up, then yes, these deposits are going to be valued at multiples of where they are. But if there is no flare up, which is the status quo continues for a long time, then what happens? Well, you just lose the premium, which is pretty much how you need to place your bets in the nickel space. Because I mean, unless you have access to the Moscow Stock Exchange and you can go start buying over there, then that's the way to do it. So for me personally, I'm not doing it. I'm not recommending it in the portfolio either. And the reason for that is because we have a lot of other good stocks in the portfolio, and I don't feel the need to take on this kind of bet. But if if this interests you, then it absolutely does work. This is the environment where those trades will work.
Yeah, I think we're in that scenario where it's like there's you can buy these things. For me, it's like nickel miners. I don't know enough about it to really jump into them. The nickel ETF, NIKL, sure, if you're really into that speculative space. The LME, you'll never see me list those trades. I talk about them here sometimes, but like as you know, Kashop, there was a time where 2022, I had a really great return Q1 2022. It would have been double if the LME didn't basically fuck me out of a lot of profits. So the LME basically, and you guys could look this up, this was Q1 22. The nickel futures just went crazy. And, basically nickel, it was nickel, lead, zinc, all went crazy. I was long all three. And then next thing you know, the LME just froze everything, gave everybody their money back. Not as in, everybody thinks when I say that, I mean, they gave me my profits and everything. No, the LME said, this is what you paid for nickel. Here's your money back. This is what you paid for lead. This is your money back. So my entry price was given back to me. No profits. So, I don't promote trading the LME. I don't really like the LME. Not a big fan of it. So if you're really into this space, maybe the ETF would be the safest way to do it. But once again, it's a very speculative space, and if Kashop is saying that it's a little bit rough to trade, I'm going to take his advice on that one and say, yeah, it probably is. So looking at any of these other areas though, with the metals, we're looking at lithium miners, we're looking at you know copper miners, steel stocks, aluminum. What are you seeing in these areas? Are there any stocks you're thinking of that are looking really good there that could have some massive upside for people?
I like the base metal space. I do have one base metal stock, which is a iron ore miner, and the reason I have that is because they have the highest grade. Now, if you're picking something that's speculative, you're better off going with quality because quality can outlast even if you're wrong on your timing. So I do have that. I do have copper. I do not have nickel, aluminum, steel, and the reason for that is I haven't really gone deeper into base metals because I think this is still very much time to play the precious metals part of the cycle because there is so much upside left in the trades that are working, which is gold and silver, that even if you go to the other metals a little later, you will still be fine. And the reason I'm saying this is because I have limited capital and I already have a portfolio that's working well. So I'm very selective on the trades that I add. Now, if I'm completely new to commodities, I have nothing, then of course, that's a different starting point. And I would be looking at pretty much all the other sectors that you listed. I would be looking at, in fact, the industrials as well and the chemical stocks, anything across anything really that will benefit from inflation because that's the name of the game today. What benefits from inflation? What benefits from stagflation? And that's where we are heading. So I would just go all in looking at all those trades that would work. But because I already have a portfolio that's working, I'm choosy about where I focus and where I add.
Yeah, I think that's what we're looking at here, which is figuring out where to focus at the moment. And I think you're right, which is we still have like a lot of areas for this thing to move up, and a lot of room to run. And so I wanted to go through this because Kashop, you're a good historian, and there's a bunch of stuff to kind of talk about here. But it was basically I was bringing this up the other day to talk about the bond market and what's going on and how manipulation of some sort and correlations they might shift, but they usually come back into focus at some point. This is something that really moved together for a long periods of time, which is the Aussie dollar yen pair. And so when we're looking at the Aussie dollar yen, basically when the Aussie is running up, you kind of have this inflationary style, reflationary style market, however you want to say it. And copper usually moves with it in a nice way. And then at some points, this got out of whack. This is the introduction of Abenomics. This is basically when Japan started going to negative interest rates, flooding the money supply, and so on. Basically, QE forever, and a lot of countries followed, went to negative rates as well. This got out of whack for a minute, and then it kind of came back into equilibrium later. And so, when I look at something like this, I'm wondering, thinking about Japan, Kashab, because you've mentioned so much about Japan. Everybody, I've gotten a lot of questions about the yen lately, which is interesting. People don't talk about currencies a ton, but now everybody's wondering about the yen because of what happened a couple of years ago with the VIX event. I think that was in August 25, or sorry, 24. And so if we look at that, what are we looking at in Japan right now? And do we think like the yen is somewhere like you just don't want to be involved in at all? I kind of have that feeling currently that I don't want to be long the yen by any means. But you're really in touch with what's going on in Japan, their monetary policy, the yen, and so on. So will you break that down a little bit for us today?
Sure. So the yen, if you're trading it, I would be very, very cautious. And the reason for that is it is at the exact same level where the BOJ did a massive intersection the last time. So the last time yen touched 158 to the dollar, I know you have the Aussie pair here, but when it touched 158 to the dollar, there was a massive intervention to make sure the yen doesn't collapse. Now, I believe they may try something of the same. We do not know. And if they do not, then it goes straight to 400. So, which is a pretty bold call. But if you look at the charts, that's pretty much where it's heading. And if you look at the fundamentals, you can understand why it's heading there. And if you look at the macro picture, then you really can understand why it's heading there because the Japanese people who are used to 0% inflation or negative inflation, that is deflation. So they have been used to deflation until the introduction of Abenomics. So ever since their Nikkei real estate bubble collapsed in 1990-91, the Japanese economy has been undergoing deflation. Now, Abenomics comes in and the guy says, we are going to have these three arrows. The first two arrows is basically we are going to print more money. The third arrow is structural reforms, which never happened. But the printing money worked in getting inflation higher. And this year, the expectation is Japan is going to have something like 10-11% inflation, which is crazy for a developed market. Now, in a situation like this, obviously it's very untenable. It's not a good look politically. It's not a good look for the BOJ. So they are going to try some intervention. Will that intervention work? We do not know. But it is going to be a very, very difficult currency to trade because it is going to be manipulated by the central banks and the government. And you may never know, the Federal Reserve may also step into the game because if you see a developed world currency collapse in short order, what does that do to confidence in the other developed world currencies? So the other G7 don't want that. It's the same. If you go back to 1965 with the London gold pool, why did the central banks interfere in the gold market? The reason they interfered in the gold market back then was if gold goes above the peg price, the USD peg price, then people are going to know that, well, the US does not have the gold to honor its commitment, so let's keep it pegged. Now, eventually they gave up because they took on too much losses, and then France, de Gaulle kind of forced them to just abandon that. But I think we're going to see something similar happen in the Japanese yen market. And the way to trade it is to just completely avoid the currency. You can trade the Nikkei. I think that's a safer bet because whatever they do, the money is going to flow out of bonds and into equities. So that's a safer bet. Plus, valuations are really good. And if you say that to anyone who's been in the macro world for a long time, they're going to be like, yeah, yeah, the Japanese equities have always been a great value and they will always be that way.
Yep.
That's the perception. So that can start changing. And if that changes, it's the same as with China. In 2024, you talk to anyone about China, they're like, oh, Chinese equities, they have been dead since 2015. Just avoid them. And then what happened? Alibaba exploded, Tencent exploded. So pretty much all the Chinese tech stocks exploded. So we may see something similar happen in Japan. So that would be the way to play it, but not the currency, because I think the currency is too risky. Now, the correlation with copper, I think That's probably going to continue. We are going to see the Aussie dollar strengthen as well. I think we're going to see all the commodity currencies strengthen. Like currencies you wouldn't have even imagined owning. So the South African rand, the Brazilian real. I think all of these are going to be great buys at some point if they are not already. And you're going to see, here's something funny. So we haven't seen people talk about forex guys having a great year for a while, and I think that's going to change. We have always heard about equity guys doing well. You have heard about bond guys doing well, but you never heard about forex guys. You have heard about crypto guys so often now. It's like I'm sick of it. But forex guys, they haven't done well in a long time. I think that's going to change this year.
I think that's an interesting take, and not to mention, I think it makes sense here, which is, you've been in this very low volatility environment for currencies. Some of these guys, they trade back and forth so much where it's like I was just talking to a currency trader the other day in New York, and he was talking about all the pairs and like how you can get a lot more alpha out of the pairs. Now, granted, like you want to trade options on these pairs in a big way, you're really going to need like an ISDA or something, or to work for a very large firm to do so. So it's a tough one to really make a ton of money in right now because of the volatility. But at the same time, like that can change at any moment. And when that does change, it's going to be crazy because the forex markets have been so suppressed for a long time. And once again, it's where the central banks come in. If central banks are all doing the same things, how do currencies actually really outperform each other? They just don't. They're just going to run sideways, be boring as shit. Nobody's going to want to trade them. And that's the way the markets have been for a while. If you could look at old things on currencies, like forex was a huge market in the 80s, 90s, 2000s even. You had big moves in these. You had the central banks not all reflating and deflating together. So you just got these big moves in those markets. It's just something that hasn't happened in a long time. I think it can happen again though. And so we're going to end with this one. So agribusiness, this is an old chart. I'll update this at some point, but Rick made this a while ago, which is the correlation between the U.S. inflation CPI and the agribusiness ETF. It kind of shows like you see these bottoms that happen, and they're all way before inflation really starts to take off every single time. And so now we have a breakout in the MOO ETF. So this is agribusiness. Things like John Deere, Scott's Miracle-Gro, and so on are in this. And now we're kind of looking at this breakout and going, here was the bottom. Here's CPI. This is probably going to follow this. This would be very normal. And then also probably the grains, we'll start to see those tick up at some point. Energy usually ticks up right around the same time. So, anything in this area that you're thinking of, fertilizer stocks, chemical stocks, John Deere, even, anything that you're thinking of in this area, and we'll leave people with that one.
So I do own a chemical stock in the portfolio, and I bought it right when the Iran crisis happened. As for fertilizers, again, the fundamentals say not now. And I was just reading Mosaic, which is the one of the top two producers in the US. So what they are saying is that North American phosphate shipments were down 20% year on year in the fourth quarter. Now, that's not good news. And they're also saying that the outlook doesn't look good. And I'm here in India, and if you talk to the people here in the rural side, they are saying it's not there, the market is not there. Now, that does not mean that things cannot change. It just means that if you're buying something right now, expect the market to remain sleepy for a while. It's like being early. So the Newmont example that I gave earlier. So if you bought Newmont in 2023, you did well. If you bought Newmont in 2025, you did great. So right now, if you're buying into the ag space, I think you will do well, but you will not do great. So which is fine if you're value conscious and you really want a good entry and you want to let it run in a retirement account. But as a trader, I'm not buying it right now. I'm waiting.
No, I agree. I own some of the agribusiness stuff, just the ETF at the moment. I will broaden out as we move forward into the cycle. All right, guys. Thank you guys for joining us on a Saturday morning. We will be with you this week on Friday. I will be in the Portfolio Accelerator event this week, so I will be a little bit scarce. I will try to update you guys as I can. But next week on Friday, I will be here in the morning at 10 a.m., joined with Kashop to bring you guys the Holy Macro Show. So we see you guys then.
Bye, everyone.